My name is Craig Picken. I'm an executive recruiter. More than a decade ago, I started my practice for one purpose: to use my experience as a former military aviator, business jet sales executive, and P&L leader to help aviation and aerospace companies and their executives be fast, adaptable, and strategic. I do these podcasts to inspire and inform, but more importantly, they are a focused platform to help business leaders grow. Welcome to the Aerospace Executive Podcast. So, hey, welcome back to the Aerospace Executive Podcast. I'm thrilled to have Andy Mansell on with me today. Andy is a well-known veteran of the aircraft leasing industry, commercial aviation leasing industry. He's a partner in Split Rock Aviation, but for the last 20 years, he's been both with Airline Aviation and Aviation Capital Group. And glad to have you on, Andy. What's happening at Split Rock?
Well, thank you, Craig. It's a real pleasure to be on. Busy days, the level of market disruption we have at the moment, I think, make for very busy times for folks like us. We're active on all sides of all parts of the industry. We try not to put ourselves in any corner because we seek to work with people we like on projects we like, which almost implies a level of fairness. So we have worked with lessors, manufacturers, airlines, and what's taken up most of our time now is more on the money side, on the investor side. There's a lot of money on the sidelines that's looking for a way to deploy in the industry.
What's keeping you the busiest? I mean, a lot of money. A lot of disruption. A lot of airplanes parked. Values are coming down. Airlines are, in Capitol Hill asking for money right now. And I got to think you've got some people who are scared to death, and the other people are waiting on the sidelines with a pile of cash, going, "Let me in, coach."
Yes, and I think when you look on the money side, the money's sitting on the sidelines. Wanting to deploy versus having a coherent strategy to deploy, I think are two different things. The easiest question for a board or a credit committee to ask someone who wants to spend a chunk of money is, how do you know now is a better time than next month or the next 6 months? And if you don't have a good answer for that, I think saying no thanks is a lot easier than saying yes please. On the investor side, I think in the US in particular, I think the majors and the large airlines have done a very good job of signaling what's going to happen if they don't get additional aid. On the one hand, you can argue that if you don't do additional aid, what was the point of the first aid? If all it does is defer the inevitable.
Right.
The thought that crosses my mind on that, though, especially in the US, is that it's not always as easy as selectively targeting a group of businesses, in this case, airlines. There's a huge support base that goes with airlines, from airports to all of the folks that operate in the airports to the supply chain. And do they protest and fight the fact that the aid is too specific if it only goes to the airlines?
You've got a whole industry. I mean, so you bring up a good point. The CARES money, PPP, whatever they call it, kept these guys afloat through the summer. If you don't continue it, I wrote a blog yesterday. It's like burning the house down. You can allow the house to burn down in 15 minutes, but if you want to rebuild it, it takes a couple of years.
Right, and there is, and unfortunately for me, I fall in this camp. I think that the bad news is actually in front of us, not behind us. Shuttering an airline is very expensive. Recommencing operations is more expensive.
Yep.
Shuttering the airline almost entirely again is going to be more expensive again. And the barometer for this is one of our blue chips, being Southwest. I was very keen to see what their numbers were going to be like when they did come out. And when you're flying 75% of your capacity year on year at a 43% load factor, and you represent the part of the business that's supposed to recover the fastest, being the leisure travel, that to me really shows you the depth of the challenge here. Southwest was out within the last week saying that it wouldn't surprise them if it took a decade for the business part of their travel to come back. And I think if you're a Southwest, the simpler your business model, the better off you'll be in the recovery. Yeah. So I think in the States, Southwest will be leading the way. The Alaskas, the JetBlues, not far behind them. But the problem for the other airlines, the entrenched legacy carriers, is there's a reason why they focus on business travel, and that's because there's not a lot of money in the leisure segment.
Right.
So if you are one of the majors and you want the leisure segment to carry you out of this, that to me looks like a long road ahead if that's the case.
So let's talk about something different. You got Frontier, you've got Spirit, a lot of the LCCs, ULCCs. Does everybody literally have to go? I mean, does the industry moving forward, does everybody have to go to an LCC model? I mean, American and Delta United got to focus on the business traveler because their costs are high. These other guys can sell seats for $50 a pop.
What a great question. Because again, you go to the Spirits, the Frontiers of the world, simplified business models. Again, they'll be in the group of carriers that recovers first. Not hard to imagine those guys using this as a growth opportunity, to grab more market share. And the very thing that makes the majors strong is going to be their Achilles heel this time around, right? And that is, you primarily travel on the majors for access to their international networks, or right. you're doing business class travel and you just want access to the lounges, the ease of travel. That stuff's at the back of the line. And we've seen the US majors try to do low cost before, and it didn't work, right? It may have been low price, but it wasn't low cost. And it's not easy introducing low cost into their business model, but frankly, they swung and missed at this, trying it previously.
Yeah, I remember. United, 20 years ago, they tried TED,
right?
And Delta tried it, and everybody, Then they tried to go the opposite way when they were running. American was running all first class Fokkers from LA to Dallas.
Right.
A lot of business plans, but then Bill Franke comes along, multiple times with Spirit, and then now Frontier, and he's like, hey, look, I got the model down, and it works. So, does this change the paradigm completely?
It has to impact it significantly, right? The only thing I think going for the legacy guys is that the low cost and ultra low cost guys are still in cash preservation mode, protecting liquidity like everyone is. So they'll have to be somewhat circumspect about how they try and grab market share. And as Southwest has proved, flying at 43% load factor on 75% of capacity year on year, I mean, it's tough as you try and generate that market again. So that's probably the only thing going for the big guys, right? Is that these guys with the mean and lean business models don't have unlimited money to throw at the market.
No doubt. I mean, they're running on thin margins too. So, you've got an incredible aircraft trading background. So let's talk about, let's shift from what the airlines do. We all know, we all know it's. I'm very happy I'm not an airline CEO right now. Let's put it that way.
It's a great time to be in the peanut gallery for sure.
Exactly. And I'm rooting for all these guys, Kelly and Bastian and Parker and everybody else. I'm rooting for them all. And but I got to think the amount of stress that they have on them is absolutely overwhelming. Let's talk about aircraft values. Let's talk about, you've got, wide bodies parked, no international travel. Will they ever come back? You've got, the heavy lifting will be on the 737, A320 fleet. How's that going to affect investor balance sheets, your lessor balance sheets? What's happening in that arena?
Well, a lot is happening in that arena, and it's an interesting one. And we can start with what I'd call the low-hanging fruit. The biggest issue we've got from the aircraft appraising community is you need willing buyer, willing seller in order to correctly appraise an aircraft. And we might have willing sellers, but I'm not so sure we have a lot on the willing buyer front. The other thing that I think people need to understand is that the cracks were there pre-COVID. All COVID has done is just like burst the dam wide open and greatly accelerated what would have happened over a number of years otherwise. And the easiest place to start is wide bodies. The most popular wide body for investors in the world's been the 777-300ER. The issue with that is that as the manufacturers pumped more and more planes into the market, the old adage that these flag carriers will never push the plane out of the fleet wasn't holding true. And with the 777, one thing that is very true is that it's too much plane for the secondary market. There is a market niche to deploy secondhand 777s into, but there's not an operator base in the secondary market. Huge base in the primary market. Now with the advent of COVID, the 787-8, the 787-9 look like the right size planes. The 777 looks like a lot of plane for this market. And when flag carriers can't deploy it, who's your guy? So those planes are going to struggle. The A330 is available in abundance. There's hundreds of A330s available. That is such a supply-demand imbalance. It's hard to imagine a scenario where those values ever recover. On the A350 front, there were whitetails, brand new aircraft, pre-COVID, almost 20 of them. And that was pre-COVID. So, the OEMs had privately acknowledged for quite a while pre-COVID that they knew they had an issue in the wide body market. Then you move to the narrow body market, a huge base of A320s and 737s. And then of course you have the Neo and the Max. Those values will have to be impacted in the narrow term. It's unknown how many aircraft will be pushed out on account of age. But if, Avalon came out in the earlier days of COVID and forecast there were 4,000 surplus aircraft in the market, of which approximately 1,000 have been retired. When you have a supply-demand imbalance of 3,000 planes, that's going to take a while to reabsorb those aircraft, especially when you put that over the backdrop of the IATA forecast is that traffic isn't coming back in the real way until 2023 or 2024. So you use that as the context. Is it easy to see values impacted 20, 30%? Sure it is.
Yeah, the business jet market. I remember, going back to the financial crisis in the business jet market. I was talking to a friend of mine, a great broker. I said, "What's a G550 worth? Right now?" He goes, "I don't know." He goes, "I don't know what the value is." He goes, "It's only what someone's willing to pay for it." And
absolutely,
if I have a willing buyer coming to the table with a check in his hand, we'll entertain the offering. You saw, 30, 40%, you saw people with wide body or, with heavy metal private, business jets taking $15-20 million haircuts on airplanes with less than 1,000 hours on them.
Right. And that's more palatable on the private jet side. The issue we have and why you won't see, I haven't seen portfolios of aircraft, of the 737, A320 variety hitting the market is we're in hurry up and wait mode from the lessor side. The lessors need to take impairments, and what will drive impairments is selling aircraft at a loss. So one thing they're going to try not to do is sell aircraft at a loss to push this out and deploy a strategy that starts with "I hope." And that, the minute they start taking losses on aircraft like the A320 or 737, that's going to be significant. It's coming on the 777 and the A330. And when you're a lessor, there's so many pain points at the moment. You have your repossessions, your aircraft on ground, your delinquencies. You have pressure on yield because of what replacement lease rental looks like. Then you have residual value pressure. You have pressure on investment grade ratings. And then you have an inability to trade aircraft at the levels you want to. And here's a simple question that's hard to answer. If I, as my challenge to you, said, if you want to value a lease rental stream for an aircraft that's going to be traded, what airline in the world can you guarantee will not be coming back to the owner of that aircraft asking for more concessions? And I don't think there's any airline that's on that list. Right. No doubt. So where do the opportunities lie? I mean, ultimately right now we got a frozen market, a little bit of hurry up, like you said, hurry up and wait. I look at,
800 Maxes that are parked, and I wonder how many of those sell for 50 cents on the dollar under new liveries. You could, so the bad news is out. Everybody really understands it's like, okay, this is a big mess. It's going to take some time to sort itself out. Where do the opportunities lie? What do you tell your clients who are looking for opportunities, and how do you tell them to, deploy a strategy?
Well, and it's a great question. This to me is where the focus initially goes on, if you like, developing a playbook, so that you've got the plays developed to the extent that you can recognize what opportunity looks like. And that means pricing in bad news on aircraft. So you have an expectation that you may be parking this plane for 12 months or 18 months, and that is being priced in. When it does deploy, you have an expectation that the rent is not $350,000 a month, it's $250 a month or something like that. And developing the plays. And I think the opportunity probably isn't within the next few months, but say anything, let's see how bad winter is on for the market. What shakes out. I think the biggest threat to the lessors is their equity being impatient, not for the legacy lessors, but think of that private equity money that's flown into the industry. Those guys aren't known for their patience. And when they're expecting return A, and then they find out they're getting return B, but there's no statute of limitation on impairments, and there could be another round coming. And whether they choose to stick or not stick is the question. When airlines do recover, if you can make it through this market, just by the nature of what this challenge is, airlines will have to take very brutal decisions, which means that when the market does come back, they'll probably be scrambling for planes again. So you can expect that there could be, I call it either sort of just bubbles of real opportunity on the acquisition side, and areas of opportunity on the supply side when airlines come back. And the advantage of newer money in this space is that airlines and lessors share an identical goal, and that goal is to survive and preserve liquidity. But while their goal is identical, it's not overlapping. And that makes them really hard to be partners together. Like you're trying to place planes at the same airlines that you're fighting with in terms of resisting restructurings and the such like.
Right.
And that's a core advantage that new money has. You can literally go in as a positive guy, as someone who wants to be a partner, because you don't have any burden of legacy with you.
That's an interesting, so I see David Nealman's out there trying to start Moxie or whatever the name of his new airline is.
Breeze, I think Breeze.
Breeze, thank you. Andrew Levy's down in Houston trying, he's getting some money together to start a new airline. And, that got me scratching. One, going back to your thing is that, your previous statement is, you're right. If so many people pull out of the market now, you could see a serious shortage. You've seen it in other industries where you go, hey, look, everybody bailed out of real estate 10 years ago during the financial crisis, or 12 years ago during the financial crisis. Then all of a sudden, home builders, are now in short supply. You could literally see where airplanes are now, Boeing, Airbus are going down to minimum rate production. You could see where in 5 years, people want new airplanes and there's no capacity to build them. So ultimately, if you're patient, the returns can be unbelievably good.
Yeah. And I think, look, this is on the lessor side, this is what a proven business model now is that you start after a correction, like something we're experiencing now, and you get out before the next one comes.
Right.
So that basically puts you on a 5 to 10 year sort of plan. I think that is, if that suits an investor profile, that is the most profitable thing you can do is get out before the next one comes. And when you look at what is coming from the manufacturer point of view, the amount of pain they're going to inflict on their supply base by the huge reductions in production, this time is different because they don't have the money to save all of their suppliers. Previously, any supplier that gets in trouble just gets sucked or pulled back in-house. and that protects the supply chain. Everyone has an inward focus at the moment, which is you protect yourself first.
Yeah, no doubt.
That's the big difference. So the ability to ramp back up as the market recovers, that's going to be slow and painful as well.
Well, it could take 18 months to 2 years just to qualify a new supplier. You think about, Triumph is out there. Triumph is struggling a little bit, and I suspect that look, I'm not into their balance sheet, and I'm not, but I suspect that ultimately Triumph will start to sell itself off in pieces. You've got Spirit out there, trying to, maybe Spirit can make a Hail Mary play and start to really consolidate and become the dominant player in the market. But it's I don't think the people that aren't deep into the industry really understand that, this building airplane stuff is hard. It is.
It's hard and it goes all the way to, galleys and seats and the IFE, all of the contents of a plane.
Yeah.
It's a huge supply base for that. And all of that supply base is going to hurt.
But, going back, I apologize. I shifted gears on you for a second. So you talk about, we've got Breeze, you've got Andrew Levy down there trying to start a new airline. Are we going to see new money coming in with
I think
new
it's
liveries?
Because these guys represent the demand side, and the lessor investor community represents the supply side. If there's one lesson that'll probably be taken away from this, is that in theory, airlines should probably want to deploy their capital on operations, maybe not all of it in planes now, which creates more leasing opportunity. But logically, you have to expect there are going to be growing gaps left in the market. I thought Breeze had a good business model pre-COVID, and I think it'll only strengthen it in the post-COVID world. Their game changer was deploying something like the A220, right? So super efficient plane for thinner, lower demand routes and connecting secondary cities that the majors didn't really care about. And you can't defend against that plan as a major with an A319 or a 737-700 because you left those routes because you couldn't make money on them.
Right.
And I think they'll have far bigger fish to fry now than trying to compete against a Breeze. I also think Breeze is almost purpose-built pre-COVID anyway for one of the majors to buy them as soon as they prove their business case out.
I sort of like the A220. Now with values dropping precipitously, back at the beginning of COVID, I was like, this is a real opportunity for the A220. It's a very efficient airplane. You can fly long distances. You put up to 150. You think you'd put 150 people on it. I live in North Carolina. To go from Charlotte to Austin, Texas, or Dallas, or every hour. I'm thinking, the A220, maybe the E2 start to see some new life, new interest. Once the dust all settles.
I think so, and somewhat fortuitously, one of the advantages the A220 enjoys is it has a relatively low production rate already, so it doesn't need that much demand for it to be from a production point of view, an almost fully deployed aircraft.
Very good point there. And the question is now, when it comes into production, can they make it as cheap as as you used? Hey, look, there's a lot of competition now with midlife 737s, et cetera. So I guess
if you look at the general, there's an oversupply of E190s in the market. So at that point, the operating competitiveness of the A220, at what point is that outweighed by the lower acquisition cost of the E190?
What about green time? We got going down through the supply chain. You've got your USM surplus parts guys. You've got some of your really successful engine leasing companies.
Right.
I got to think green time engines will be at a premium. If you've got engines with some green time on them, you're going to be someone whose phone is ringing off the hook.
Well, I'm not sure it'll be off the hook because of the sheer number of green time engines that are out there. So if you're an airline that owns the planes, then you'll probably harvest your own green time engines to avoid doing shop visits. Next up on the list of harvesting is disassembly and reassembly, where literally you're just taking modules of engines to create life in other engines, or sending engines to the shop just for a surgical strike. Then you'll see a divergent strategy from lessors. If I was a lessor, I'd be pushing all of my airlines pretty hard to, it's like, don't worry about what the lease agreement says. Let's relax that return condition. Here's another engine. It has 3,000 cycles on it. That's grand. And when you look at that supply-demand imbalance, you could do that what will feel like into perpetuity. Like if you can't get a plane out the door, then swap engines. And you're not saving money, but you are obviously pushing cash flow, further out there. There's going to be a lot of it, and the engine guys that are out there, the big guys, tend to be very good at what they do. And I think what you'll see is a much bigger push towards more comprehensive fleet solutions for airlines. So stop treating this like an MSN, and let's start talking about all of your other types, 737-800s, or all of your A320s, and we will guarantee that every engine has at least 2,000 cycles on it, and we'll do it for this cost, either upfront per month, whatever. But the deployment of a really fulsome engine fleet solution, I think it's not new, but I think you'll find a lot more energy expended by the engine guys to make sure that their inventory is deployed as best as it can be.
Yeah, but keeping the shops open for the long haul. I mean, ultimately, long term, shop visits are down. Once again, you're creating, how do we, once again, protecting the supply chain. Ultimately, shops you're going to need to keep that skill set. Do we need to keep,
It's the possibly the only business model right now that's worse than being an operating lessor is being an MRO who's deeply committed to invested in engines. And the guy who's probably worst off is Rolls-Royce, right? So not only are you exclusively focused on the wide-body market, but you built a vertical integration model where you don't have anyone else really doing those shop visits. And this has been proven in the charter business of yesteryear, particularly in the UK and Germany, where the tour operator wanted to own the travel operator, wanted to own the airline, and wanted to own the hotels, because that way you swept every penny off the table and you weren't sharing it with anyone. Downside is when the bad news hits is that there's no partner committed to sharing the downside with you. You own all of it. And that's the position that Rolls is in today. It doesn't have a significant partner who's invested hundreds or billions of dollars in supporting their product. They wanted to do it all, which leaves them really, really challenged, I think. Fast forward to, or jump across the Atlantic to something like a Pratt & Whitney. I was doing something with them recently, and they had an interesting take on this, is that one of the way that you can bring engines into the shop is to do upgrades for people. There's a carrot for someone, and I'm not sure commercially how big the carrot is, but to offer to upgrade engines as a means of enticing people to bring them in the shop, that I think is an interesting strategy.
Well, the one thing that's interesting is, the industry's full of smart people, and they tend to get pretty crafty.
Right.
Everybody's like, hey, look, it's not how we did it, yesteryear, but it's a new day. The reason we have smart people in the company is to figure out how to bring some revenue in, and let's look at everything. Let's put everything on the table, and we'll look at it.
Yeah.
And if
one of the interesting things in there, Greg, is that in that list of smart people are now auditors. And as the industry has matured, so has the auditor skill set. And a lot of decision making is driven by your impairments, which are driven by mark-to-market concerns. And this is where the real threat is for lessors. When you can break aircraft out into a small subset, so for example, you might have had some A1 powered A320s, and you take an impairment on one, you say, but we've only got 4 of them. And that's what you impair against. If you have 100 737-800s and you impair one, the auditor is going to look at all of them in terms of around this vintage. So what you often see people doing, unless they decide to bite the bullet and take the impairment, is they'll pick their oldest plane because they don't have very many of them. They're not going to pick their youngest planes because that's where they have the most of. And so much strategy will be driven by this. For example, there are lessors out there whose accounting policy was, just because it never made a difference previously, that you split the value of your capital A aircraft, 1/3 airframe, 1/3 each engine. So now, if you want to sell an engine or do something with it, you're attacking 1/3 of your book value. So, you need to bring an engine, a little e engine back and make it a capital E engine on a capital A aircraft to avoid impairment. My point being is that the industry is more sophisticated than it used to be, and you'll see a lot of what best economic outcome will be driven by accounting decisions.
Yeah, no, that's a good point. Where does the new money come from? So look, I'm a firm believer that here's what I think the scenario I think happens is treatment for COVID comes out, vaccine treatment, whatever. Everybody's talking by the end of the year. 6 months distribution to the populations. And then 6 months after that, maybe businesses start to get people back to the office. And I think a lot of air travel is going to be just getting people back into the offices and the work. And then ultimately, once that happens, people will start to feel comfortable getting on airplanes again. So it's probably, we're probably talking a year from now to 18 months. And then, everybody's saying another year after that to get back to 2019. But 2019 was a bull market.
Yeah, it was.
Where's the money? Where does the money come from to support is it, Goldman, is Goldman out there? Is it Blackstone, BlackRock? Is it, big hedge funds going, hey, look, this is a good, or are they saying once bitten, twice shy?
I think if there's one thing the market's taught us, there's no such thing as once bitten, twice shy. This is a short memory industry for a lot of people. Not to mention, there's a lot of younger blood in the industry that's never seen a downturn. They've heard that it's cyclical. They just didn't understand, what that really looked like. And I would say, if we use the once bitten, twice shy analogy, that all of the sharks will be circling. Real briefly, I think this winter is what will drag 2021 down and make it more of the same, if you like, on a blended basis to 2020. I don't think people are nearly as afraid of flying as it's often portrayed. I think people are just a lot more binary in the sense that you said, vaccine. Until there's a vaccine, there's not a lot of interest from a lot of people to get out there, binary thing. But I think the one thing that the aviation industry has and going in its favor, and it's not a big one, but it's most of our previous challenges and crises have been more directed at the industry. When you look at, from 9/11 to SARS to the volcano in Iceland, very aviation specific. This is across the entire economy. And when you are money, you're one of these big funds, every industry's hit. So it's a case of looking at where recovery, the elasticity or the recovery potential of an industry.
Yep.
And I think for the aviation industry, the elasticity of it is proven, the recovery aspect is proven.
Right.
And that's the attractiveness of the industry to investors. It's like, this has got to be a good time. Might not be right now, it might be 6 months, it might be 12 months, but we should be ready to go. Let's not follow the industry, let's get in front of it so that we know what it looks like, what we're after. Yeah.
And that's a little bit, I was thinking about our podcast days coming in. I was thinking, hey, look, the best time to invest when everybody's just totally deflated. So it's probably about right to bring some money and start to think about, hey, look, the blood's in the water, we'll start to pick up assets, or we'll start to think about it. But then I start to think about, hey, look, what are other ways the industry can grow? And you think about AI. Can we start to put in, AI systems that, when you buy your ticket online, you take your picture. And when you show up at, the gate, or when you show up at the security line at the airport, it recognizes your face. There's facial recognition. Just go on, go right on through. Same thing, at the gate when you're jumping on the airplane. There's Andy. We know he's in seat A, 1A. Welcome aboard. I think that there's a lot of opportunities now to say, hey, look, maybe this is a good time to get the entire industry, not just the aircraft or the airlines, but you're talking the airports, you know, investing at a higher level to operate at a more efficient level across the board.
Could completely agree. And this would be, to me, an excellent example of why you want your playbook ready to use when something like this happens. Because what better time to roll out new technology? And another huge one is in air traffic control. There's so much inefficiency just in the US with air traffic control. But if that playbook had been developed, this would be a great time to roll out that technology. So while the skies are not full, what better time than when you're flying at a severely reduced traffic flow?
Yeah,
it would be the perfect time to do exactly what you say.
Yeah. So ultimately, I'm here in 2024. Does it take that long? Do we get back on our? Do you think it's sooner? Think it's later? Do you think 2024 is about the right number? What's your crystal ball say?
Well, I think the devil's always in the details. If you take that entire world industry, 2024 sounds very reasonable, but it's going to be a very uneven application. Both we've seen it in support, but also in recovery. Will the Deltas, the United, the British Airways, the Singapores, the Cathay's of the world, the Lufthansas, will they be flying at the same international long-haul capacity in 2024? No, I don't think so. I think that traffic will take longer, partly because of how they're slashing their fleets. Will they slash just to try and rush back in there? When you talk about US traffic, for example, or take segments of the LCC, ultra LCC, domestic traffic generally, sure, I bet that's back by 2024. Wouldn't surprise me if that's back by 2023. It's when you blend in long haul, and then are you talking to, just the shorter international routes, or you're really going big with these? So I think if you break all of the traffic down into buckets, some buckets will be back before, and some will take a heck of a lot longer to get back there. And part of that will have been how the airlines reacted to the crisis that they're faced with today.
Right. And ultimately in the international side of the house, you've got a lot of, these, the high cost airlines, and they're now ultimately going, all right, we can't, our model is not sustainable.
Yeah. And a big one that's out there, Craig, of course, is does one of the US majors go Chapter 11?
Yeah. Or two.
Yeah. And if two go, it wouldn't surprise me if three go, and then you've got a whole new playing field again.
Yeah, that's probably for another. Yeah, I've heard some people say if one goes, they all go. It's hard to compete. If one guy gets to reset all of his costs, it's hard to compete against that. We've seen it before.
Yeah. And I think just to conclude on that, my rule of thumb with that is if one goes, I think two goes, but whether number three goes all comes down to their outlook. Because if their outlook is, we actually think that recovery will be more weighted in the 2022/2023 timeframe, they can hold on. If they think it's 2024 and beyond, and they look at that like, wow, the competitive landscape has just slanted so much against us, we're going to have to go too.
Makes my head hurt. Will you come back on again once we start to get through the other side?
Oh, I'd love to be able to talk positively about stuff. So it would be a pleasure, Craig, to come back on.
Hey, thanks, Andy, for coming on board. And Andy Mansell, partner of Split Rock Aviation. Thanks for coming on today, talking about the industry.
Yeah, great. Thanks for having me, Craig.
I hope you enjoyed the latest edition of the Aerospace Executive Podcast. You can reach out to me directly, Craig at NorthstarESG.com, or check us out at www.northstaresg.com. You can subscribe to this podcast on iTunes, Stitcher, Podbean, or on YouTube. Just do a search for Aerospace Executive Podcast. Thanks again. I'm Craig Picken.